Hi everyone, welcome along to this Squirrel webinar. We'll be talking primarily about the investment side of what we offer today. Thanks for coming along and making the time. Righty ho, I'm expecting you to read this and there's a test on it at the end. This is a disclosure statement. Broadly speaking, it says, I'm not offering you financial advice today. I'm providing you with general information and providing general product information. You'll be able to look at this on the YouTube clip once it's posted. We'll have the disclosure statement stated there. Today's agenda. All right, so I'll be talking for about 20 minutes and then we'll move into into Q&A mode. I'm happy to stick around and answer as many questions as you want to ask me. We'll kick off today though with a bit about what's going on in the economy and the housing market. We'll talk about the Squirrel lending portfolio, and I'm excited to chat about the Squirrel monthly income fund today. Without further ado, we'll kick off with the economic and housing information. I'll fly through these slides relatively quickly. And actually, I should add, if you have questions along the way, don't be afraid to put them in the chat function or in the Q&A box, and I'll answer those when I get to the end. I see we've already got a couple in there, which is fantastic. Thanks for popping them in. All right, I actually used this graph when I did my last webinar, which I actually think was November. Normally, I'm doing them slightly more frequently so slightly a bigger gap between, so apologies for that. What is this telling us? So if you look at those two orange arrows, they're pointing out recessions in New Zealand in the last sort of 15 years. So you go back to the GFC, 2008, 2009 was a pretty gnarly time for the New Zealand economy. And we're seeing a similar pattern taking place today. I think this winter is going to be a pretty rough place for the economy, based on what we're seeing and hearing around the place at the moment. This graph indicates the amount of activity going on in the economy, and it's one the Reserve Bank, and I know a couple of the banks track quite closely. If we look at that same information on a per capita basis, so basically dividing it back through by the number of people that live in New Zealand, if you look at the recession area sort of through 2008, 2009, the amount of activity dropped by about $450 per person. If you look at what's happened over the last 12 to 18 months, it's dropped by about $600 per person. So despite having a much larger population than where we were 2 years ago, actually the outcomes economically are people are not spending in a retail sense. That money's been sucked up by rent and by interest payments, it would appear. Moving on to the housing market. So this graph comes out of ANZ Economics. It uses the New Zealand House Price Index and compares it to sales and listings. And we've found sales and listings, or they've found sales and listings, a good indicator of market direction. So you can see there's a reasonably tight correlation there between the light blue line, which has been advanced 5 months, and the house price indicator. What you can see is that light blue line over the last sort of 6-9 months has been pretty squishy, and if anything has been starting to fall a little again. I suspect we're going to see house prices, we'll call it bumping along the bottom over the next 6 to 9 months. Obviously, if anyone's got a crystal ball and got a better view than that, feel free to share it. But that's what we see. Looking at what's going on in the building market, so if you look at the dark blue area and the light blue area, that's indicating the number of consents. You can see that they're falling from what was a pretty outrageous peak going back into those first few years of the COVID era. You can see that they're falling quite quickly now. It wouldn't surprise me if we got down as low as the GFC period, which you can see in about the middle of that graph, 2008, 2009, 2010, through to 2012. So there's about a sort of a 3 to 4 year period there where building activity was really weak. I suspect we're going to see the same thing off the back of this, based on the developers that we chat with on a regular basis and what we're seeing in the market more generally. Pretty hard to go past a Squirrel webinar without chatting about interest rates. So just one very brief anecdote here. If you look at the one bank average 1-year term investment rate, that looks like it's peaked at about 6%. I don't think we're likely to see rates over 6% or certainly substantially over 6% on average any more during the course of this year. You might still see some specials around that 6% or just over mark. If anything, I think we've probably peaked and rates from here are more likely to slowly reduce rather than seeing any big increases or any big reductions. Moving on to the Squirrel portfolio now. So these two pieces of information, so the graph on the left and the table on the right, give you a sense of what's going on inside our portfolio. So first of all, I'll talk to the graph, which is the amount of credit risk that exists in our loan portfolios. I'll focus just on the home loan and construction loan portfolio. I'll come to personal loans when I talk through the table. So what you can see is we reduced our credit risk appetite going back a couple of years ago. And you can see that flowing through in the portfolio. That credit risk for construction loans is rolling at around about 0.35%. And I'd expect it to stay between about 0.3 and 0.4% in the foreseeable future. For home loans, you can see the credit risk is very low, running at about 0.3, 0.4% at the moment. That's probably really low in the long run. I'd expect it to be a little higher than that over time, but not dramatically so. So if we look at the amount of credit risk, the credit risk in the portfolio is running at, we believe, really appropriate and healthy levels. If we then look at the table on the right-hand side and look at our reserve funds, you can see the three different portfolios, the amount of money invested in each of those portfolios. I think I took this data on yesterday or Monday night. You can see the size of the reserve funds supporting each of those portfolios and the amount that we're reserving. So you can see those portfolios all look in pretty healthy condition. The key stat that I want to point out is the reserve levy. So this is how much we're reserving on average across each of those three portfolios. And you can contrast that with the numbers that you see in the graph. So if we start with home loans, you can see we're reserving at 0.26%. And the amount of credit risk in that portfolio is modeled at 0.03%. So we're reserving a significantly higher rate than the expected risk in the portfolio. Same things goes for construction loans. So the credit risk that we've modeled in the portfolio is about 0.35%, and we're reserving at around about 1%, where you can see 0.98 there, which is basically 3 times. So we're reserving at about 3 times the level of expected risk in the portfolio. So we think we're playing a pretty conservative game in the way that we reserve there. Last portfolio is personal loans. For those who have been investors with us for a while, you'll recall that we believe that the personal loan reserve fund is in a very mature state relative to the size of that portfolio. So this portfolio is about 11 million, and there's over $1 million in that reserve fund. We're currently reserving at 0.85%, which is at about the expected credit loss rate. Okay, and the reason that we're reserving at about that rate is because we think that portfolio is nicely mature. And for those who have invested in personal loans for a while, you remember you got an increase in the interest rate you were receiving last year. All right, so overall, we believe portfolios are in a healthy state. And if we look at this on both an arrears and over term basis for the home loan portfolio, we've never had a loan go into arrears. We've had a couple go over term. You can see those reflected in the orange line on the graph on the left-hand side, top left. And we don't have any loans in hardship. So that portfolio is very healthy on that basis at the moment. If we look at our construction loan portfolio, remembering there's 170 active loans in that portfolio today, you can see that there are some loans over term, so currently 4 as at the end of April, and we've got 1 loan that's in arrears at the moment. The one that's in arrears, we think the property's for sale, and we'll think it will tidy itself up when that property is sold over the next couple of months. And for the loans that are over term, that's not one series of loans that are constantly over term. That's a rolling number of loans that have gone over term. Often they go over term by a month or so. Often they're waiting for council consent before a property can be sold, as a typical scenario, or they've had delays on the project in some way, shape, or form. So there seems to be a small constant group of loans that do roll over term in that portfolio. That's expected behaviour, and we don't believe anything untoward. Graph at the bottom looks at our personal loan arrears and at the hardship rate. So you can see the arrears running at about 4.5%. That's at the end of April. We're not concerned by that. That's about usual. If you look at the pattern of the graph and you look at where the economy's at, actually, if anything, the personal loan portfolio is in a really healthy state, particularly with the size of that reserve fund that backs it. Good one. All right, moving on. I'm going to chat through the next 3 slides on the Squirrel Monthly Income Fund. So the Squirrel Monthly Income Fund, we actually launched in October 2021. So it's been around for about 2.5 years now. The fund itself invests in first mortgages secured by residential property. And if you've been with Squirrel for a wee while, you'll know often we talk about our home loan portfolios and our construction loan portfolios regularly, and that's what the fund invests in. A few features about the fund. So for making withdrawals from the fund, it has a 30-day notice period. We endeavour to pay out the withdrawals as soon as we have the cash available to do so. So on average, it runs at about 15 days for people to get their money out. However, we allow ourselves up to 30 because it can't take that long to make that cash available. We make one monthly distribution, which is your return, and you can elect to have that paid out to you or capitalised onto the balance of your investment. So there's a lot less noise compared to investing in Squirrel term investments, where often you'll see activity where investments are coming back all the time, or you're getting bits of money returned to you in the form of returns during the course of the month. For the fund, you'll have one payment made each month, which some people find a lot simpler to understand and operate. We have reserve funds backing all of the loans in the portfolio. So we believe that's a healthy way to run, and you've seen how the reserve funds are performing a couple of slides ago. I'll talk about some of the stats before I come back to the tax element. So fund has today about 10.5 million in it. There are about 400 customers who are investors within their fund. It's 160 loans in the fund. That's both fractional investments and whole loans. Right, moving on to high tax. So the fund is taxed a little differently than Squirrel's term investments. So Squirrel's term investments taxed under the resident withholding tax regime. The fund is taxed under the PI tax regime. So for any of you who have KiwiSaver, for example, that's also taxed under the PI tax regime. A bit more information about PI tax because it's structured slightly differently to resident withholding tax. This table on this page talks about an example of an investor who invests in Squirrel term investments with resident withholding tax applying, and one that invests in the Squirrel Monthly Income Fund with PI tax applying. So the example that I've given you is an investor who earns more than $70,000 per annum. They've invested $10,000 and they're earning a return of 7.5% in both the term investment and in the monthly income fund. Gross return over a 12-month period would be $750. We're assuming that the returns aren't reinvested, so we'll just take the gross return, which keeps life simple. Tax rate. So resident withholding tax for someone who's earning $70,000 a year would be 33%. For the managed fund, that is 28%. So if you are earning more than $70,000 a year, the tax in a PI-based managed fund caps out at 28% as an individual. So there's a tax advantage there for investing in the monthly income fund. So how does that translate then into your after-tax return? So your return after tax under resident withholding tax scenario is $502.50, and it's $540 under the monthly income fund. So if you take your 10,000 and divide that through by the amount of the return, you'll see you get a return of just over 5% under the Squirrel term investments, and you'll end up with a return of 5.40% after tax using the fund. All right, so there's a tax benefit there for higher income earners. And interestingly, based on the way the other tax rates work, there can also be a benefit for lower income investors as well. It can get a bit tricky and a bit complicated. So if you want to work out what your own high tax rate is, there's two ways you can do that. The easiest way is if you simply go to the IRD website and you search PI tax rates. If you follow through the pages there, there's a couple of calculators that can help you work out what your PI tax rate would be. If you search for resident withholding tax rates there, you'll be able to check your resident withholding tax rate also. The other way you can do it, if you log into the Inland Revenue System regularly, if you log in, you can actually find, if you log in, go into the income tax area for you personally, and you'll see that they actually list the actual PI rate. So they've calculated it for you if you have that login. All right, so the real difference at the end of the day, so once tax is paid on the actual returns for some investors, depending on whether you invest in term investments or in the fund, and that's laid out in that table for you. Just a side note, for the monthly income fund, tax is paid once per year in April. So you calculate your returns over the course of the year. That tax is then paid in April. We look after that for you with our fund administrator, so there's nothing more that you would need to do. So we calculate it and pay it on your behalf. If you've invested and haven't made any withdrawals during the course of the year, then when we get to April, we'll let you know how much that tax is. Often the easiest way to pay it is that we'll deduct that from your current investment balance, and that gets your tax squared away. I would also note, by doing it on that basis, you've also had the benefit of earning returns on returns that you've earned during the year, and compounding those without tax having been paid during the course of the year. So you kind of get the benefit of some compounding going on by investing in the fund and tax being paid that way at the end of the year. I'll contrast that with the way resident withholding tax works, which is we deduct that as your returns are earned. All right, tax can be a bit of a tricky thing. I'm not providing tax advice here. You can check it out for yourself on the IRD website. So how has the fund been performing? Okay, so what we've done here is lots of lines on that graph. The orange line is the return of the Squirrel monthly income fund. It's a rolling 12-month return. So you can see with the fund starting in October 2021, you can see the first reported return is October 2022. And we've also assumed that your returns have been reinvested. So you're getting that compounding effect going on. So had you invested from day one, fund currently has returned over the last 12 months, so at end of March 2024, around about 8%. If we deduct the fees off that, that brings it back to about 7.5%, give or take. So if you invested today, your first month return is going to be running at roughly 7.5%, having removed that compounding. We've put a 1 year, the rolling 1 year term deposit rate. So we'll source that information from the Reserve Bank. That's the black line on the graph. So if you've been investing in term deposits, they've been running at present at around 6%. So it's about a 2 percentage point difference there as it stands today if you were reinvesting. We've also compared it to some other managed funds in the market. So on the right-hand side there, I've listed out the funds that we've compared. So there's a Devon Fund, Macquarie, Milford, Mint, Nico and Harbour. They're all income-based funds, so they're all aiming to pay regular returns to their investors. The bluish coloured line on the graph, that shows the average of how those funds have performed over time. And you can see back at the start of that period, when interest rates were rising really steeply, they had negative returns. And those returns, as interest rates have peaked and in some cases started to fall a little bit, those returns have popped up to about where the Squirrel fund is. The green line is the best performer as at March 24 of that group, which is the Harbour Income Fund. So just to give you a contrast there of not just taking the average, so we take out the under, so that we've got all the performers who have been lower in the table. I've also shown you the highest performer. So what you get with the Squirrel return, assuming that we can continue to have the portfolios performing well, is a regular, reliable return. Okay, that's what we're demonstrating. That's what we aim to deliver to you. I'll note that the data for this was taken from Aon. There's a link you can see down at the bottom of the page there. So when we publish this on YouTube, you've got to find that link and go have a look. All right, nearly reaching the end here, team, and moving into Q&A zone. I've gone just over 20 minutes, so it's about right. So how to invest? The reason that I'm talking to you about it today is we're about to launch the capability to invest via our platform, or via the Squirrel app in about 2 weeks' time. So we're deep into testing of this at the moment, and I've just grabbed a screenshot of what that might look like from what we're testing at the moment that you can see on the right-hand side there. So you've got the ability to invest via Squirrel in about 2 weeks through our app. You can also invest via Invest Now, and a good chunk of the 400 existing investors have done that. Once they've chatted with us, they've gone and registered with Invest Now and invested there into the Squirrel Monthly Income Fund. If you are already an investor on the Invest Now platform, you can simply allocate money to the Squirrel Monthly Income Fund. Last but not least, if you work with a financial advisor, we are listed on the FNZ Wrap platform. So you're welcome to access it that way as well. All right, pretty excited about having the fund on the platform very soon. And I know there's a number of investors that have been chatting to us in recent times that are waiting for it to arrive so they can start investing that way. First question, have you set a date for joint accounts? We don't have a date yet, unfortunately. We have started to scope the work. We've got one other major thing that we need to get in before that. I would expect it'll be late this year or early next year. So we're probably about 6 months away from that. All right, next question. Will any change in the OCR affect the interest rates that you offer? The simple answer is highly likely. So if I give you a slightly more detailed answer to that question, if you hold money in the Squirrel on-call account, that is closely linked to the OCR. So if the OCR goes up, it's highly likely that you'll see an increase. If the OCR goes down, highly likely you'll see an increase. And that's likely to happen the day after the OCR announcement occurs. So if you see an OCR change, highly likely we would be shifting our on-call interest rate. For our home loan and construction loan term investments, those are variable rate term investments. And while they're not driven by the OCR, it's likely they'll move at around the same time. If you think about the way that, for example, term investment rates and home loan variable rates move at a bank, then the home loan and construction loan term investments will move in a similar fashion. So normally within about 3 or 4 weeks, you will have seen some change once an OCR change occurs. So that's what typically happens. But they are not explicitly linked, I think is the easiest way to describe it. And we've seen the way that the banks operate has decoupled from the way that OCR works at times. The best example of that was during the global financial crisis back in 2008, 2009, where the OCR went down really low, but the banks savings and term investment rates actually stayed up quite high relative to where the OCR was. They've come back a bit more into balance since then, but yeah, they're not explicitly linked. Thank you for that question. All right, question from Gary. So can the app be changed to show orders ahead of me instead of having to create an order to see them? Gary, that's one of the things on our list. It's not currently prioritized, but yes, it's definitely something that we will be looking to do. It's probably after joint accounts, so we're probably 6 months away from that. But yes, I can understand from an investor's perspective why you would want to see that. Thanks, Gary. All right, the question relates to where Squirrel takes a mortgage on a property. Part of the agreement that we have with the borrower is that that insurance, that property will be covered by insurance. If a borrower was to let their insurance lapse, then the insurer is required to let us know that. So if that was to occur, we would know and we would be taking action to make sure that property either was insured by the borrower or if it was heading down a mortgagee sale path, we would be insuring it ourselves at that point. So while it's possible that it could occur, it's highly unlikely that it would occur, assuming that the systems and processes that are in place with the insurance providers are letting us know that insurance had lapsed on a property. I think that answers the question, Brian. Feel free to pose a follow-up question if I haven't answered that correctly for you. I'll probably just actually add that if you're a bank, you also demand that properties are insured, and the insurance companies will also let the bank know if, for example, insurance lapses in some way, shape, or form. All right, thanks for that question, Brian. Next question up. Will you be considering lending to businesses? Well, we do lend to businesses today that are in the business of building property or building residential homes. We aren't considering lending to businesses for other general purpose type lending. So for example, if it was equipment finance, they need to buy a new ute, we don't consider lending in that situation. So for our home loan and construction loans, all of that lending is secured by first mortgages and related back to residential property. We're not securing stuff, for example, against an excavator or lending cash flow lends to businesses. That's not what we're in the business of. We're in the business of secured lending for home loans and construction loans primarily. So thank you for that question. All right. The question relates to what does overterm mean? You'll see I referenced that in one of the graphs. In fact, why don't I pull that graph up while we are chatting so that you can see it. Yeah, so on this page, those top two graphs both reference overterm. So the typical situation is that a loan is written for example, 12 months long. I'll use construction because that's the one where you see that happen most often, which is the top right graph and the orange line. Often we find the borrower expects to build the property and get it sold or move it on, whatever the expected outcome will be within that 12-month period. If they get delays, then that can mean that the loan might run over term. There are two things that Squirrel would consider doing if a loan is going to run over term, and we typically know that this is going to happen before it happens because we're in touch with those borrowers during the course of their project. That might, if the borrower expects that the council is going to issue consent, for example, on the finished build within a few weeks of that loan running over term, then it's highly likely we'll allow that loan simply to run over term. The borrower pays a higher rate, so the loan's technically in default, so they're typically paying a higher rate for that 2-week period, or 3-week period, or 4-week period, however long it happens to be. And that default interest goes into the reserve fund, and then the loan pays back and investors get their funds back. So there is a penalty for a borrower running over term. If a project is delayed for a longer period of time, Squirrel may extend the term of that loan. In that situation, borrowers investors would be repaid, we would write a new loan and start fresh. Typically, that would occur where we expect that loan to run over term by more than a few months in that situation. How often does the interest rate on the monthly income fund change? The returns are calculated every day and paid on a monthly basis. You find the return does move around a little bit each month based on loans coming in and out of that portfolio. However, it's been running in a reasonably stable way at around 7.5% during the course of this year so far. So it will move in and around that by a little bit. The time when you'll see the interest rate start to move in a particular direction is when the short-term interest rates in the market are starting to move. So if you see the OCR moving one way or another, that's normally an indicator that you'll see the returns on that fund move up and down. Next one up from Rachel. What percentage of your investors come from financial advisors for this fund? I would say today a smaller number. I talked about 400 investors in the fund. I'm going to guess that there's probably less than 50 that have come from financial advisors. What we've found is we've been chatting with financial advisors. They really want to see a 3-year return on the fund before they really want to sort of investigate more and look at it. So we have our 3rd birthday for the fund in October this year, and we'll be out talking to a lot more financial advisors at that point, Rachel. Thank you for that question. Next question from Mark. Is there an upper limit for the reserve levies? If so, what happens to excess funds? If not, would an unlimited accumulation potentially get unnecessarily high? So I guess that's the situation where we think a reserve fund's got to the point of maturity, where the portfolio is stable in its size, and reserve funds got to the point where we think it is very comfortable in being able to support the credit risk in that portfolio. Best example I can give you of that one, Mark, is the personal loan reserve fund today and personal loan portfolio. So we think that personal loan reserve fund is in a very mature state. Based on the credit risk in that portfolio and the size of that portfolio, we are reserving at the same rate of the expected credit losses. So we're not reserving more than that because we think the reserve fund's got plenty of capacity in it to manage anything that's thrown at it. So for the reserving on our construction loan portfolio, I would say it's not mature yet, but it's certainly grown a lot. So we're up at almost $2 million in that reserve fund now. And if you think about the number of loans that could support if there happen to be losses, actually it's quite a large number because, you know, if we were to take a loss on a loan, you're probably looking at maybe somewhere between 50 and 250,000, give or take, on any given loan. So that's actually quite a large number of loans that it could support that fall over. The other thing is because we're reserving every day into that fund. Let's say we had a loan fall over today, the reserve fund drops by 100,000. If in the unfortunate event there was a loss, it's actually gaining almost 100,000 a month based on existing reserve levies. So, you know, it could drop 100,000 today, and most of that money would have been made up by the end of next month, based on the amount of money that's in reserve levies going into that reserve fund as it stands today. So it's something we monitor every single month. We report that to our board every month, and we discuss it every month. So home loan portfolio, while the underlying credit risk is really low in that portfolio, there's about getting towards 300,000 in there. That one's still relatively immature, so we want to see more growth in there. Not that I believe there's any particular risks or anything around it. Construction loans has grown really nicely, and once again, not mature yet, but certainly growing nicely and ready to handle anything that's thrown at it. And personal loans, it is mature. So long answer to that question, Mark, but I think it warranted it. So thank you for that one. All right, Mark's question. So what's the rationale for investments to be individually matched between a loan and an investor? So Squirrel has a peer-to-peer license, which is why for our term investments, you see that really tight match. The Squirrel Monthly Income Fund that is not matched in the same way. So while the fund can take investments and fractional investments and loans, we don't tag individual loans to individual investors in that structure. So I guess you've got the best of both worlds with Squirrel. If you like the way that we operate from a peer-to-peer perspective with the backing of the reserve funds, then you might want to invest in the construction loan term investments. If you prefer the structure of being in a pool, then the fund would work really well for you in that situation. So think, Mark, we've got the best of both worlds and both options available for you. I hope that makes sense and I've answered the question appropriately. Feel free to toss in a follow-up. All right, the question is, what types of interest can loans pay at Squirrel? For our home loans could be principal and interest repayments, or they could be interest-only repayments. For our construction loans, the vast majority of those loans are interest-only. There are some that are interest capitalizing in that portfolio, albeit investors earn interest, so we make interest-only returns for investors on that. And for personal loans, it's a mixture of interest only and principal and interest repayments on loans. I would note that across all three portfolios, borrowers can make early repayments on their loan as well. For home loans and construction loans, expect interest-only payments and the occasional early repayment or partial early repayment on a loan. For personal loans, a lot more of them have principal and interest payments that are going on. So there's a mixture, I think, is the answer to the question. For the principal repayments and interest-only repayments, today, all of that goes back to your on-call account. The major item that we're working on at the moment, beyond delivering the fund onto the platform, is to give a whole lot more features, so to allow you to have multiple on-call accounts and separate your investments into different buckets as well. That's taking us a long time to design because it gets quite complicated. We've run a couple of sessions with customers so far to help us with doing that, and I think we've really nailed that design in the last week or two, and we'll be going back out to customers to chat about that. I expect that will be delivered before the end of this calendar year, and I'm quite excited about that. And I know there's a lot of investors looking forward to that when it gets done. Thanks for that question, Jared. Next question from Natalie. Is everything in the queue for investing on a FIFO basis, or does the size of the investment impact on how quickly an investment is taken up? It's all on a FIFO basis. So FIFO, first in, first out. So if you are an investor and you look to sell an investment, it's placed into the queue. As the investments in front of you are gobbled up by other investors, you'll make your way to the front of the queue. And then once you reach the front of the queue, typically you'll see your investment repaid quite quickly. It can, you might wait for a week or a few weeks to get to the front of the queue, depending on which particular portfolio you're selling in. Once you get there, though, you'll see all of a sudden you start getting repayments. I've had one investor describe that process to me as feeling like it was a bathtub that empties. So at the point at which you reach the front of the queue, the plug comes out of the bath and all of a sudden you see your investment drain back into your on-call account as other investors come along and buy that from you. Different portfolios do move at different speeds on that front, Natalie. But definitely on a FIFO basis, we think that's the fairest way to operate. So the size of your investment, all those things don't matter. $100 is treated the same as $1 million in that sense. All right, next question is from Mark, and it relates to other differences between investing in term investments versus the monthly income fund. I talked about the PI potential tax advantage for some investors. Other reasons, so one is liquidity or redemptions. With the managed fund, because it invests in there's lots of underlying loans in that fund, I think around 160, we have loans maturing all the time. So every month there are loans maturing, which means that we have the ability to repay investors' capital on a regular basis. So you've got a 30-day notice period for withdrawals from the fund versus with term investments, you sell via the secondary market. At the moment, secondary market's working really well for investors. It has done over the last 8.5 years that we've run, with one exception, which was really during that first couple of months of when COVID started to percolate in New Zealand. So if you go back to sort of February, March, April 2020, our secondary market really slowed down at that point and was taking investors sort of 4 weeks to sell, 4 to 5 weeks to sell at that point. Today, obviously, things are running really smoothly. You can sell through the secondary market. That tends to tick along reasonably well all of the time. If all of a sudden there were ructions in the market in some way, shape, or form, either it's with Squirrel or in the wider market, you could see your ability to sell via the secondary market slow down with term investments. So that's the risk. Versus the fund, where because it's got investments maturing all the time, it's got the ability to make decisions about whether that capital is reinvested or paid back out to investors. So yeah, that ability to withdraw, I would say, is the other big difference between the two. There is a slight difference in fees. It costs us money to run the fund over and above the term investments. So there's an additional fee there. As far as how that plays out in your after fees returns, at the moment, the fund is returning about 7.5% after fees. And construction loans are at 7.5%, and the home loans are at about 7%. So, you can contrast the returns with the liquidity. Those are probably the two main things that I'd look at. The second part to Mark's question here is, how is it that the managed fund, so the Squirrel Monthly Income Fund, can deliver a return at around 7.5% after fees, and it's investing in both home loans and construction loans? All right. So the answer to that is the managed fund will invest in whole loans at times rather than taking a fractional loan. Those whole loans still have a reserve fund backing them, but because they're taking the whole loan, the fund can effectively negotiate a slightly better rate of return from Squirrel. And that's what drives that slightly better return. It'll be there or thereabouts, though. I wouldn't expect they're going to vary massively over time. It's still there or thereabouts. So Squirrel may take a slightly lower margin. Reserving may be slightly different between the types of loans that the fund is taking. And it's doing so kind of as a wholesale investor, I think would be the best way to describe it. Squirrel has other wholesale investors that invest with us. They get a variety of returns, but they may not have the backing of the reserve funds for other types of wholesale investors. So they're taking more credit risk in that sense. The next question is from Bill. Where are the funds in the on-call account invested? If you check out the webpage for the on-call account on the Squirrel website, it says they're invested with main banks. There are 2 main banks that we currently put that money with, and it literally lives in bank accounts with them. Because we hold, and you can see this on our website, about 130 million, we have negotiated good rates of investment with the investors, with the banks, and that's what allows us to pay a great rate of return for you. Squirrel takes a small margin, that's about 0.25% on that money at the moment. So we're earning at about 5.5%, and investors are earning at 5.25%. So we're really transparent on that, Bill, and you can see that information on the website. Yeah, so that the money in the on-call account literally sits in bank accounts with 2 of New Zealand's main banks. What are the differences between using the Squirrel app to invest in the monthly income fund versus the Invest Now platform? So with the Squirrel app, you'll have access to Squirrel's on-call account, our term investments, and the monthly income fund. Investing on Invest Now, they've got something like 150 different managed funds on their platform. You can also access term investments from banks via their platform. So if you are investing with Invest Now already, you may find it more convenient simply to invest into the monthly income fund via Invest Now. There are no differences in the returns that you'll get between investing via Invest Now and investing via Squirrel. So yeah, it's really, if you're already an Invest Now customer, then you may just find it more convenient to invest via them. Invest Now also have a KiwiSaver scheme. So if you're invested via that scheme, then obviously you'll be logging in and familiar with their platform. So you may just find it more convenient. There are no return advantages between the Squirrel app, investing via the Squirrel app, and investing via InvestNow. Thanks for that question, Louise. The question looks at, I think, relates to wholesale investing with Squirrel. So Squirrel has a range of wholesale investors that invest with us. There might be, I don't know, maybe 40 or 50. To be a wholesale investor, that typically means you're investing or have investable assets of over 750,000, or you can demonstrate that you have the necessary investing knowledge, and that is certified by a lawyer or an accountant or a financial advisor to say that you do have that knowledge. And if you are in that position, then that opens up other investment options with Squirrel. So if you're in that situation and you want to chat with us, you can email me directly on dave@squirrel.co.nz, and happy to talk to you about the other options that we have available. Typically, those options come with higher credit risk, which is why we don't talk about it with our retail investors, because we want to make sure that what we're offering to our retail investors, we're really comfortable with the credit risk, and we believe it's appropriate for our retail investors, which is why we kind of separate things on the basis of wholesale investors versus retail investors. And to put that in perspective, we have almost 8,000 active investors on the Squirrel platform today. Around about 8,000 active investors. And as I said, there were around about 40 wholesale investors, give or take. So the vast majority of what we do is with our retail investors. Thank you for the question. Great questions today, by the way, team. So thank you for firing all those in for me. Oh, crystal ball time. Given the RBNZ signals, what's your anticipated time frame for the OCR to begin to drop? All right. So clearly I can't predict the future, but I can certainly give an opinion. And I guess at Squirrel, we're not afraid of giving opinions. So if we look at how the economy is performing, the economy is not going particularly well. We're seeing unemployment rates go up. You can see the amount of activity, which I showed you in those graphs at the beginning of my presentation today, is really weak. We're seeing confidence and people's willingness to go and buy a big ticket item is really low. We're seeing the number of houses on the market being really high, which probably indicates there's not a lot of buyers, despite there being a lot more people in the New Zealand population right now. So that weakness will toll at some point with the Reserve Bank. While their mandate very much focuses on inflation, they do have other things to consider. We know during most interest rate cycles, the Reserve Bank's a touch late in raising interest rates and a touch late in lowering interest rates. There's real risk of that this time round, and you'll see from other commentary and blogs that Squirrel's put out that we believe the Reserve Bank's at real risk in this particular part of the economic cycle of holding that interest rate up for too long. Okay, so there's an opinion. Maybe the other way of answering is, what are wholesale markets predicting? So if you look at interest rates in wholesale markets, then they would suggest that the first drop in the OCR will occur in November or February. So November this year or February 2025. Take that for what you want. And remember that those wholesale markets, that's real investors putting money down one way or the other on what they expect to happen. So they're effectively, they're making an investment decision with that information, which is what's driving those wholesale interest rates. So if you want me to put a stake in the sand or a line on the ground, end of this year, early next year, I'd expect you to see it falling. Reserve Bank, in their last announcement, which was last week, said we won't be dropping interest rates until the middle of next year. So somewhere between those points is probably the truth. And good luck to you, Jared, with figuring that out from what I just delivered to you. All right, next question. What is the future landscape for peer-to-peer lending? Do you see this as a growth market? Well, from a Squirrel perspective, we've been really happy with the regulatory approach and how things work for us. There are other peer-to-peer lenders in the market. There are three that are quite active. So Squirrel, there is another company called Zagga, also focused in and around residential mortgages typically, and one other which is Southern Cross Partners. So three quite active peer-to-peer providers in the market. We think the ability to fractionally invest is a really powerful thing. And we see peer-to-peer in lots of other parts and other markets in New Zealand. So Uber would be, a really good example of something that is peer-to-peer, not described that way, but that's effectively what's happening. From a financial markets perspective, that ability to fractionalize things is actually super powerful. And you see that in all sorts of other parts of the financial market. So we expect to be doing this for a long time into the future, because we really like that ability to fractionalize. We think that works really, really well. And we think when it's supported by reserve funds, as the Squirrel model is, which is unique in New Zealand, but not unique offshore, you get a really powerful combination for investors. So, it allows us to run the secondary market, which works really well for investors. And yeah, we see lots of advantages. Hope that answers the question. Thank you for that one. All right, this is a general question about how investments in home loan and construction loan term investments work. So broadly speaking, you need a minimum investment amount of $100. You'll place an investment order for $100 or more, and we'll tag that to a loan. That means you've got invested. You'll start earning your returns from the day that your investment starts, and you'll earn your returns on a monthly basis. When that investment matures or the loan is repaid, your investment capital will be returned to you, along with any returns that are owing at that point in time. And you have the option of either reinvesting or holding that cash for yourself and doing something else with it. You can invest whenever you like, so you can add, you can start a new investment at any time or place an order at any time. And if you're partway through your investment and you want to try and get that cash back, you can use the secondary market to sell your investment to other investors, which is as easy as ticking a box online. All right, so that was a very general overview. Hopefully that gives you the answers to that question. It looks like there was a follow-up question from Kushal, which talked about whether investments are locked in. So with our term investments, when you're invested, your investment will run for the length of the loan, but you have the option of selling early via the secondary market if you choose. Next up question, just to clarify, so it's like the stated figures regarding the returns on the monthly income fund at about 7.5% pre-tax. We're including the annual management fee. So that's correct. So if you invest today, your return is going to be around about 7.5%. That's after fees and before your high tax is paid. So that return's running at about 7.5%. And I think the easiest way to contrast that is 7.5% would compare to our term investment rates. And that they're on a similar basis. So that's kind of after Squirrel's margins and fees, but before resident withholding tax or PI tax applies, depending on whether you're investing in term investments or the managed fund. I think that answers your question, Jared. If you have follow-ups, don't be afraid to hit me on dave@squirrel.co.nz. First question is from Rory. Why the difference? Home loans, 4 hours versus 18 days, as opposed to personal loans at 31 days and 29 hours. So I think your question, Rory, might be about how long does it take to get invested? So for home loans and construction loans, we have loans available for you to invest in virtually all of the time. It's very rare for us not to have loans for you to invest in, and that includes investors who are selling on the secondary market. From time to time, we might catch ourselves out at the end of the day where an investor comes in and places a large investment order. Occasionally we have someone come in and place an order for $1 million and those sorts of things, and we may not have had quite enough loans on the market at the time. So occasionally we get ourselves caught out, but it's highly unlikely you would go more than 24 hours to be invested in either our home loans or our construction loans. Personal loans is quite different though. So for personal loans, we can't originate loans fast enough to satisfy investor demand. We're quite picky with personal loans. We really focus on homeowners because that's the market that we know best. And that can mean that we can't originate the loans as fast as we want to. We reject about 75% of the personal loan applications that we receive as not being high enough quality. So yeah, we're quite picky in that space. Unfortunately, that means there's not loans to invest in as often as our investors might like. There's an alternative approach there would be for us to lower our credit standards and let a lot more loans through the gate. However, that comes with the downside that we know what happens in that situation is more loans will go bad and that will hammer the reserve fund, which we don't want to see happen. So we typically always have home loans and construction loans available. We have our own facility that we settle those loans into. And so as there is demand from investors, we put them on the market. Personal loans, we can't originate the loans fast enough to meet investor demand. So that's why the difference is there, Rory. I think that answered the question. If I didn't catch any nuances there, feel free to ask an additional one. Thanks for that, Rory. Next question from Kieran. Why is the home loan reserve fund at such a low level? Well, when we think about reserving for home loans, because the amount of credit risk in that portfolio is really low, we don't reserve as much as we do into some of the other portfolios, which means that it takes longer to grow. So it's a pretty simple factor of the amount that we're reserving. And if you recall back to our graph, and if I go backwards to that one, this one here. So for our home loans, which is the orange line on the graph, the credit risk in the portfolio is running at about 0.03%. And you can see the reserve levy, which is the top right number in the table on the right-hand side there at 0.26%. That's the amount we're reserving. So we're reserving it on quite a conservative basis relative to the amount of credit risk in the portfolio. But because the overall level of reserving is lower and the portfolio is smaller than, for example, construction loans, it takes longer for it to grow. So it adds about, we're getting close to about $10,000 a month being added into that reserve fund portfolio, between 8 and 10,000 typically each month now. So it is starting to tick along nicely. The portfolio is in a really healthy state. We have no particular concerns around that. Thanks, Kieran. So question from Nikhil. What are the typical kind of borrowers for home loans? So our home loan borrowers, I'll give you two examples. First example would be, or actually I'll go back a step. Where we've set our lending products hits niches in the market that the banks typically aren't good at meeting. So there are a couple of niches that I'll call out for home loans. One of them would be older borrowers. So if you're 60 years old today and you want to borrow $200,000 for a major renovation on a nice property in metropolitan sort of Christchurch, Wellington, Auckland, your chances are you're sitting on a lot of equity on that property. However, the bank looks at an application from someone in that situation and they say, well, we're not actually sure how you're going to pay that loan back because, 5 years from now, it could mean that you're in a situation where you're only earning bank super, when in reality, the intent of that borrower is to go through the renovation and sell the property, unlock the capital and downsize. Really typical life stage scenario. But banks are not good at lending in that situation for a whole range of reasons. So that's one example where Squirrel can be a bit more flexible for the borrower. We typically write those loans for 2 to 3 years, gives them the flexibility to get through the project, and it allows them to leverage the equity that they have in what is typically their largest asset, which is a good thing. We believe a good thing. And credit risk, as I said, in that portfolio is relatively low. Second example that I'll give you, Nikhil, would be a business owner who's going through a divorce. their financials tend to get disrupted for a couple of years. They tend to be strong borrowers, strong business income, but they've got to make their way through the messiness of getting through that divorce and the financial splitting of their financial arrangements. So in that situation, often Squirrel can lend for 2 or 3 years. And at the end of that 2 or 3 year period, typically they've got themselves tidied up, got through the divorce, back on an even keel, and they refinance the loan back to a main bank at that point. So we've helped them with some flexibility during that period of financial disruption, I think is the best way to describe it. Thank you for that question. I'll keep on moving on. I think that's Kieran just saying, thank you for helping me out in a particular situation a while ago with getting a withdrawal made. So no problem at all, Kieran. Glad to hear we were helpful and gave some great service along the way. Good one. Thank you, Kieran. Appreciate that. What is a whole fund? I think maybe the question is a whole loan. If you recall back to the discussion that I had about the Squirrel Monthly Income Fund, I mentioned that sometimes we'll have fractional loans and sometimes we'll have whole loans in the fund. So fractional loans is where we're effectively buying on the Squirrel marketplace, just like you do when you place an order for a term investment. The fund might have a new investor that comes in today with $40,000. So we'll invest that $40,000. We might split some between home loans and some between construction loans, for example. So we're taking some fractions of some loans, just like most of our investors do. From time to time, though, we'll have an investor who might come along and they might invest 500,000 or maybe $1 million, or we have a large repayment on an existing investment. And that may mean, as an investment manager, we say, well, we're going to invest in a whole loan at that point. So we'll look at the loans, we'll select a loan that we like the look of for a whole variety of reasons. That also allows us to think about negotiating the rates and getting a good return on that loan for our fund investors. So I think that was the direction of travel of that question. If I didn't quite get the gist of it, feel free to ask a follow-up question. All right, thanks for sticking with me, team, and thanks for all these wonderful questions. I think it really does bring things to life. Question from Nigel. What are the fees on the Squirrel Monthly Income Fund? So if you read the product disclosure statement, and you can find that on our website today. So if you go to the Save and Invest menu on the Squirrel website, and you look at the drop-down menu that comes down, you'll see a page for the Squirrel Monthly Income Fund, and you'll find the product disclosure statement on that page. The fees are quoted as 2%. That sounds like a really high fee, right? And the reason it's high is loans are expensive to manage. And the way that the FMA has required us to report our fees is we take effectively the borrower rate and take off the investor rate or investor return that's been delivered, and that delivers the fee. So that covers both the margin that Squirrel makes to manage the loan, which for the fund is running at around about 1.5%. And then there's a fee, which is for us to manage the funds, because managed funds are quite expensive beasts to run. So that fee is around about 0.5%. So in total, it's 2%, which feels like a really high fee relative to other funds that you might have. And the reason for it is loans are expensive to run, which is the Squirrel margin at about 1.5%. Remembering that banks' overall margins are running at about 2 to 2.5%. So let's create some perspective on that. And then there's the costs to run the fund, which currently are running at about 0.5%. Hopefully that answers your question there, Nigel. Thank you for that. And as I said, full disclosure in the product disclosure statement around that. Second question from Nigel, which is, can you invest in the income fund via the Squirrel platform? I might have covered that towards the end of the presentation after you asked the question, Nigel. So 100% you will be able to in about 2 weeks' time. 2 to 3 weeks, we'll have it there and ready to go. We're right in the thick of testing and making sure that's right before we go live at the moment. So you'll see it pop up in 2 or 3 weeks. Which gives you then, for our Squirrel investors using the Squirrel app, you have the on-call account, the managed fund, and term investments available to you at that point. Thanks, Nigel. There's a question which is, how might I switch money currently invested into home loans with Squirrel to the monthly managed fund? The easiest way is actually to sell your investments on the secondary market. and then reinvest once they're available to you via the Squirrel Monthly Income Fund. So easiest way is to sell your investments if you want to switch either out of construction loan term investments or out of home loan term investments. And then once that cash is available in your Squirrel on-call account, you can then invest in the Squirrel Monthly Income Fund. I think there's about 2 additional questions you need to answer when you do that, and you'll need to have a read of the product disclosure statement before you invest. So yeah, it'll be relatively simple once it's available on the platform for you to do that. Thank you for that question. Promise that wasn't a seeded question either. Question from Kieran: how does the on-call account differ from the Squirrel Monthly Income Fund? All right, so with the Squirrel on-call account, let's first of all talk about where the money is invested and how the return is generated. So for the Squirrel on-call account, that money literally is put into bank accounts at 2 of New Zealand's main banks. Okay, both AA- rated banks. So what's your credit risk in that situation? You'd say, well, what's the risk that the bank's going to fall over? Probably pretty low at that point, you would expect. So the amount of investment risk that you have there is very low. Squirrel Monthly Income Fund is investing in loans, if you recall back to the discussion. So it's investing in loans. It has higher credit risk. So that credit risk will be probably running at around about 0.35%, give or take. So similar to the construction loan portfolio, maybe a touch lower, around about there. And so you've got a different risk profile between the on-call account and the Squirrel Income Fund. So that's the key thing. So Squirrel on-call account, money's literally sitting in bank accounts with 2 of New Zealand's main banks. Squirrel Income Fund, the money is invested in loans. Second thing that's quite different is the speed at which you can get your money out. So the on-call account, money's back in your bank account in about 2 hours, 7 days a week between 9 a.m. and 11 p.m. So really easy to get your money out and back into your bank account. It's literally just the only reason it takes a couple of hours is that that's how the banks operate. So we can only make it go as fast as what the banks do. For the Squirrel Income Fund, because the investments are in loans, it actually takes a little longer to get the cash out, which is why it has a 30-day notice period on withdrawals. So when you want to withdraw partially or fully from the Squirrel Monthly Income Fund, it may take up to 30 days. On average, we've typically paid out in about 10 to 15 days, but we allow ourselves up to 30 days. So really big difference on liquidity and how you get how quickly you can get your money out. Obviously, the returns are different as well. So on-call account, 5.25% per annum. If you compare that to what's available in the market, I suspect you'll find that's a really strong rate, probably one of the best, if not the best in the market with that type of liquidity. Squirrel Monthly Income Fund has a higher return, running at about 7.5% per annum. However, it's going to take longer to get your money out. So those are the trade-offs that you would make between those 2 things. Thanks, Kieran. Nikhil, question: will there be a benefit of investing into the Squirrel Income Fund via the app than Invest Now? So if you invest via Invest Now or you invest via the Squirrel app, you will have the same return. Okay, so there is no difference in fees that you pay or the returns that you will get whether you invest via the Squirrel app or you invest via Invest Now. To make that really clear. So Invest Now does not charge you a fee when you invest in funds that they have on their platform. Can't quite remember for Invest Now whether they charge you a fee in relation to term investments that they have on their platform. You'd need to check with Invest Now on that front. But if you're investing in the Squirrel Monthly Income Fund, there is no difference in returns or fees that you are effectively charged. Thanks, Nikhil. Right, question from Kieran: when will the on-call account allow me to keep some of my money in the on-call while allowing auto reinvest to work? I can tell you, Kieran, we've been working really hard in designing exactly what you've just described. It's quite a big build. I think we've cracked the final elements of the design in the last week or so. We'll need to do another round of testing with our customers to make sure that we've got it right. And then we'll build it. I would expect we'll have that live before the end of this year. So it's quite a big build. I'm quite excited about what I've seen and how this is going to work. and it will work and just do exactly what you just described, Kieran. You'll allow yourself to partition money into different buckets. You can hold money on call in different buckets. You'll be able to invest in term investments in different buckets. You'll be able to invest in the fund in different buckets and keep money separated, because we know a really large chunk of people want to be able to separate and automate. And this new feature will allow you to do that. As I said, we're probably not going to deliver it until it's hard to put an exact time frame on it. I'll say somewhere October, November, December, somewhere in that zone. Thanks, Kieran. Question from Ruth. We invested in a loan in February. It was repaid in April. Not given any notice on this. Would you typically let investors know the loan has been repaid early? All right. So with all three of our term investment classes, we allow borrowers to repay their loans early at no cost. Okay. If from an investor's perspective, if you are investing in home loans or construction loans, the money is received back early. But because we always have loans available, you can get reinvested straight away. So is there a downside there? Not really. If you are not keeping money on call particularly, you can turn on auto reinvest, and that means your funds will stay invested all the time. If you are a personal loan term investment investor, then that gets a bit trickier, because it can take a lot longer to get invested in loans. So getting money back early isn't always a desirable thing when you're earning the returns you expect. One overarching comment I would make, though, is you are far better to be receiving money back than to have money not being received back and loans going bad. So if we kind of, on balance, would prefer that borrowers paid back early than let their loans run to term. We think the way that we operate on that basis is better than the way that banks operate. So, if you go and break a term investment with a bank, typically there is some sort of break fee that you're going to pay, either via a reduced interest rate, whereas you don't get that with Squirrel. So we think that's a real bonus, that we don't charge fees if you want to break your term investments earlier. Equally, if borrowers pay back earlier, we don't charge them either. And for any of you who have had home loans and needed to break one, you can see that they can sometimes be quite expensive to break. So we think that's just a big money go round. On the bank side, we understand why they charge those fees, and there are legitimate costs there, but it's a real money go round. So our view is, actually, we're not going to charge you if you want to use the secondary market. We're not going to charge borrowers to also pay back their money early. Getting their money back is always a good thing when you're investing in loans. Thanks, Ruth. Hopefully I've answered your question. Oh, sorry, there was another part to the question, which is, will we give you notice on it? The answer is no. And the reason is, sometimes we only know on the day that that a borrower is going to make a repayment. So we don't always get a lot of notice ourselves in that situation. You should see a notification, though, to say that you've got a return paid to you. So if you're keeping an eye on your Squirrel app, either logged in via a desktop or on the mobile app, you should be getting notifications which will tell you that you've received money back. So that's the easiest way, that's how we do tell you when it comes back, but we don't get advance notice often of money coming back to us. All right, thank you, Ruth. All right, is there a minimum term for investing in the monthly income fund? The answer is no. So you can put your money in today, get yourself invested, and then tomorrow you can put your withdrawal notice in if you choose to. Now, clearly that's not going to deliver you a lot of interest when you do that. Typically, we would recommend that you're investing for more than 12 months, typically 2 years. However, there's no downside to you pulling out earlier than that if you need the money back for whatever reason. So no minimum term. Key thing, though, is you have a 30-day notice period for withdrawals. Thank you for that question. Next question, will the monthly income fund be available on the website? Yes, it will. So if you're looking for information on the website, then yes, it's there today. So if you have a look at the Save and Invest menu, I think it's the third item down on the Save and Invest menu in the first column. You'll see the monthly income fund there. So you can see information about the fund there, including monthly fact sheets and the product disclosure statement. And you'll be able to log in via a desktop computer once we have it available for you to invest in via the Squirrel app. You'll be able to do that on your desktop as well once you log in. Thanks, Rory. Question is, do borrowers only pay interest only? There's a few different answers to that question. So from an investor's perspective, for our home loans and construction loans, all of the loans in those portfolios today are interest-only loans. We do allow for a home loan to be principal and interest. So that means they're making some principal repayments and interest payments. Typically, we don't have any of those. I can't think of one that we've written off the top of my head, and we've written about 80 or 90 loans in that space life to date. Most of them are interest only. For our personal loans, there is the vast majority of our personal loans are principal and interest paying loans, which means as an investor, each time you get a repayment on one of those principal and interest loans, you're receiving part of your principal and the interest owed to you each time that payment is made. I think that answers your question. Thank you. Question from Rose. What are the fees for the monthly income fund? I think I touched on that earlier. So the fee is 2%. The 7.5% return that I quoted earlier on, which is about what the fund's returning at the moment, is after fees and before tax. Okay. So fees about 2%, 1.5% is Squirrel's margin to operate, and the other 0.5% of that 2% is the cost for us to run that fund. Thank you, Rose. Another question from Rose. Any advice for small-time investors deciding where best to place their funds out of the Squirrel offerings? I can't give you personalized investment advice there, Rose. Partly it might come down to tax efficiency. So depending on the income that you earn, you might find you're better off in the term investments if you want to select the amount of risk that you're wanting to take. So if you're wanting the lowest possible risk that we offer, or most conservative risk, then you might want to go into the home loan term investments. If you're comfortable with a little bit more risk, you might be a higher income earner, then maybe the monthly income fund might be something that is worth checking out. Equally, if you want to go into the personal loan space, the only way you can access that is via the term investments. And to be clear, we have investors with $100 on our platform. We have investors with millions of dollars on our platform. So we have a really wide variety. And one of the things we love is that we treat the person with $100 exactly the same as the person with a couple of $1 million. There is no difference in the way that we treat you, which we think is fair. If you go into a bank with a couple of million, you might get treated a bit differently to the person with $100. I think the best example I can give you for a bank, if you want a term investment with a bank, you need to have at least $5,000 and in many cases $10,000 before you can invest. With Squirrel, you can start with $100. I think that's a much better way to go and keep things fair. Thanks, Rose. Threw a few extra bits in there for you. Sorry, Rose, I should also say, if you head on to the website, you can actually book a time to chat with us directly. It'll either be Doug, our investor relations manager, or myself. So you can book some time if you want to chat through what you're doing and what you're interested in. We can make some suggestions about the best options for you to consider. Alrighty. Another question here from Kieran. What will the return be on the monthly income fund? So it'll be running at around 7.5%. I wouldn't expect it to vary a lot from that based on where interest rates are at over the foreseeable future. So the next, say, 6 months, I think it'll be running at around about that 7.5% zone per annum, that is. Thanks, Kieran. How is Squirrel protecting investors from banking or internet fraud? Could investors' funds be stolen? All right. So I think there's two parts to the answer here. So part one is, what does Squirrel do? And then part two is, what does Squirrel do for investors? So Squirrel ourselves, we have bank grade security around our platforms. Okay, so we operate in a very similar way to the way that the banks do, as far as making sure that some hacker can't access our platforms directly in some way, shape, or form. We leverage a lot of services from Microsoft to help us do that. We have a company called InfoSec who audits us and works with us to check our security. We run penetration testing on our platforms. We do a whole lot of stuff in that space and audited on it. We're intending to become SOC 2 compliant. We're most of the way there on our way through that, which is a industry standard for cybersecurity. So we're doing, we think, the best job that we can to manage that. Our board ask us on a regular basis what we're doing in that space. We regularly check what we're doing. We're making sure we're trying to run best practice as best we can at all times. So that's part one of the answer. Part two of the answer, what do we do to help our investors stay safe? And there's a few things we do there. So first of all, we have multi-factor authentication in place. So you can choose to turn that on. We don't enforce it because not every investor wants it. We know that. However, you can turn that on. So you can turn that on in the app. Just go to the cog in the settings and you'll see multi-factor authentication there for you to be able to turn on. So that's one way we do it. The other thing that I really like about the way that we operate at Squirrel is there is one way in and one way out. So when you set up your bank account with us to begin with, whenever a withdrawal is made, it goes back to that same bank account. So that means a hacker would both have to be able to get into your Squirrel account and your bank account in order, A, for them to log in as you into your Squirrel account, withdraw the funds. If you've got multi-factor authentication on, that's going to be really hard for them. And then once it's back in your bank account, they would then need to be able to withdraw the money from the bank account that we've locked in with you. So I think that's a really, those two things, multi-factor authentication and the fact that money can only come in and go back to that one bank account that we have with you, are strong things that we do to help you. So yeah, protecting ourselves and yourselves from cyber fraud is a two-part story. One, what Squirrel does, and two, what we do to help you. So hopefully I've answered that question for you. Thank you. Can you cancel an investment order? You sure can. So if an investment order hasn't been filled, you can literally log in, go to the orders menu. In there, you'll see all of your orders there. You can cancel an order. So just click into the order, cancel it. The money will pop back up and your on-call account is available to invest, and then you can place a new investment order. So that's a really easy one, and we're well catered for that. All right. Can you explain the process of the reserve fund kicking in if a borrower misses a payment? I see some loans for investments have arrears from time to time. Is the reserve fund making up those missed interest and principal repayments? Very simply, the answer is yes. So that's what the reserve funds do. They act as that final buffer to try and help protect our investors against credit losses. So let's talk through how we do that. First of all, we have three layers of defense for our investors. So first of all, when a loan application comes through, we go through all the usual checks that a bank would do before we lend. So we're checking the borrower's credit profile, we're understanding the project, we're understanding what security there might be, we're doing all those usual things that a bank would do. So loan applications, that's the first check. Second check is that we'll take security where we can. So in the case of our home loan and construction loan portfolios, that'll be a first mortgage on residential property. In the case of personal loans, there's a wider variety of security that would be in place for personal loans. However, we'll take security where we can, and about 90% of the loans have or over 90% of the loans have security in place for personal loans. So that's the second thing that we do. Third thing is the reserve funds. Okay, so let's say a borrower has happily been making payments on their loan. For whatever reason, they miss a payment on the loan. At that point, the reserve fund steps in, makes that payment to investors. And so investors are happy at that point, assuming the reserve funds have money in them. Then when the borrower catches up on that payment, which invariably they do, they owe that money back to the reserve fund, plus probably some default interest and probably a small fee to go along with that. So that's how the reserve funds work. That's a completely automated process. So we don't kind of get involved in that day to day. Our platforms are doing and running that process for us. In the event of a loan defaulting completely, I might just talk through that. So what happens if, for example, a construction loan borrower defaults on their loan, builder goes bust, a situation like that? At that point, Squirrel would consider either finishing the project, if it's construction, for example, and then we would go to mortgagee sale if the property wasn't already sold. So it depends on the situation. When we go to sell the property, if there is a loss relative to the value of the loan. So if I give you an example, let's say it's $1 million property, Squirrel lent 800,000, so maximum LVR at 80%. The market tanks and drops 30%. We sell that property at mortgagee sale for 700,000, just for argument's sake, makes the math easy for me. So that means there's $100,000 loss. So the value of the loan was 800,000, sold the property for 700,000, there's $100,000 loss. Reserve fund steps in and makes up that amount for our investors. Now that assumes the reserve funds have money. We don't guarantee the reserve funds. And you can see the size of them on the page that's actually happens to be in the background here. So yeah, the reserve funds act as that final shock absorber. We don't guarantee them, and we can't predict the future. 8.5 years in, they've worked perfectly for investors over that period. Hopefully that answers your question. Thank you for that one. That was a great question. Question from Peter. Invest now requires $200 minimum, usually $50 if on an investment plan. All right. So what will you be able to do through the Squirrel app? So through the Squirrel app, your initial investment has to be $100. And ongoing investments, I think we've got set at $50. Might be 20. I think it's 50. So there is also a minimum, there's a cost to processing transactions and those sorts of things. So we do have minimums in place. The minimum for an investment when you start it off is $100. If you want to invest regularly, which you'll be able to do, you can set that up with $50 a time. So you might want to save $50 a week, $50 a fortnight, $50 a month. You can obviously save more than that also if you choose. Thanks for that question, Peter. Next question, why would we use other platforms instead of using what we already have? Good question, thank you. So there will be some investors out there today who already use, for example, the FNZ platform via a financial advisor. They might already have investments with InvestNow and other funds provided by other fund managers, and it might be convenient for them to use a platform other than the Squirrel app to invest via. So it's a convenience thing primarily as to why some investors may choose to operate in a different way. We think the Squirrel app is fantastic. I think the capability that you'll have there when we release the funds is terrific, and it will get better later this year when I talked about those buckets earlier on, being able to separate your money into different spaces and keep it separated and have auto reinvesting working for you. Thank you for that question. Next one. If people use InvestNow, then does Squirrel pay InvestNow for referring people to the fund? Yes, we do. So there's a small fee that Squirrel pays to InvestNow for hosting the fund. I think that's the easiest way to describe it. InvestNow has something like 150 different managed funds. So all of those fund managers will be paying a fee to InvestNow for hosting their fund on there. Question, can I use Squirrel's on-call account for my business? Are there any limits or costs for large, frequent transactions? You can set up an entity, whether it's a business or a trust, with Squirrel to use the on-call account and use the others, use also the term investments and for the fund. So the simple answer is yes. There are no costs that we put in place for investors in that situation. Clearly, the account is not designed for high frequency transactions, right? It's not designed for you to be kind of putting, 20 transactions in a day and withdrawing 20 times. It's not really designed for that, given it's not as easy to access as what your bank account is. So if you're putting money in once a day or taking money out once a day, it works perfectly for that. It's not really designed for you to put money in multiple times a day. You can, but it's not really designed that way. And certainly withdrawals, if you need that money and you're going to make payments out of your bank account, for example, then you probably don't want to be faffing about with taking, 2 hours to get money back so you can make payments and things like that. But we have quite a large number of entities that are set up. So when I say entity, that's either a business or a trust in some way, shape, or form, who hold money with us in different ways. Thank you for that question. All right. I think that's Kieran letting me know that being able to bucket up your money is a great thing. So he said that in caps. I won't shout, but I get the point. Thanks, Kieran. Question from Judith. Seem to have a construction loan, 8 weeks over term. Is that okay? So Judith, we do, as I said, from time to time, we will have investments that run over term. Um, Sometimes they might run up to 3 months. You can always sell that investment if you're not happy about that situation. All of those loans that are over term are actually still current. So the investor's still, the borrower is still making their loan payments. So there's no reason to think that that loan won't repay. And I'm not aware of any loans in our portfolio right now that I have particular concerns about where they may end up in default. So uh, that decision's up to you, Judith. I don't have any particular concerns, but if you feel concerned about it, you're able to sell it. It may take longer to sell because we'd consider that loan to have had a credit event given it is over term. Okay, so just be aware of that. Thanks, Judith. Question from Daryl, do you have a specific date for the launch of the monthly income fund? If not, will you be able to let investors know when it's launched? 100%, Daryl. I'll be out with bells on, letting you know once it's available. As I said, about 2 to 3 weeks from now, so maybe the week beginning the 10th of June, or maybe the week beginning the 17th of June. I would say it'll be in one of those 2 weeks when we're ready to go, based on where we're up to right now, and that testing's looking pretty good. Thanks, Daryl. We'll certainly let you know. How is the risk measured for each reserve fund? Thanks, Chantal, good question. So if you look at the graph that on the page that we're on at the moment, and I say, well, our construction loan portfolio has got 0.35% risk in it. What we're doing is we're taking each loan that's in the portfolio, we're thinking about the probability of default. So what's the likelihood that the borrower is going to default on that loan? And multiplying that through by the potential loss if a default on the loan occurs. So this is a classic credit equation. When you do those two things for all of the loans in the portfolio, you can derive your expected credit loss, which is what that 0.35% is for construction loans and 0.03% is for home loans. When you go through that, and so we've effectively built a model to support that process, a credit model. I won't get into the whys and wherefores of that model. We've loosely based it, or largely based it, on Standard & Poor's, who are a large ratings agency. They have a credit model that runs for residential lending in Australia and New Zealand. So we've taken that model and we've modified it slightly to suit the fact that we do some slightly different things on average than what the market does. So, there's not really too many construction loan portfolios out in the world that they're prepared to share their credit model on. Equally, we wouldn't share our credit model on it. However, we do measure things and report on them on a monthly basis, so we can understand the amount of risk that builds up in those portfolios. As far as the reserve funds go, we're then looking at a ratio of the size of the reserve fund, the amount we're reserving relative to that credit risk. So that's part of the reporting that we send into our board each month. I put that together for them each month and they review it, and will pass comment if they're unhappy about something or they think we don't have the settings set at the right level. Clearly, there's a lot of experience within Squirrel, I think, across the board and senior management team. It's about 200 years of financial services experience across that team. And largely speaking, a lot of Squirrels have come from banks. So we're bringing all that banking knowledge to bear in the way that we do things. Thanks, Chantal. All right. This is the last question that I've got. So if you want to ask any more questions, now is your time to get those fingers flying on the keyboard. This question, does Squirrel offer home loans to property investors or only to owner-occupiers? The majority of what we do is to owner-occupiers. However, there is the occasional loan that we do for a property investor. Often it's for a shorter term, so we're lending to that property investor, might be for a 12-month period while they're reorganizing their portfolio. A loan with Squirrel will be more expensive than a main bank. So there's typically got to be a reason why Squirrel is the right lender for that borrower. And typically it's because they're doing something that might not quite fit the bank box or they're reorganizing things in some way. So that's the typical situation, but there's not a lot of property investors in the portfolio. In fact, I can only think of about 3 or 4 loans in that home loan portfolio today that are property investors. The remainder are own occupiers in some way, shape, or form. All right. Thank you for that one. All right, I got a thank you from someone to keep up the good work and keep going for the whole Squirrel team. So thank you for that, Julia. There are no other questions that have popped up, so I think I'm going to close things down now with a thank you to you all for your attention and staying online and listening to that Q&A. The vast majority of you stayed right through to the end, so well done on that. Thanks for your time. Enjoy the rest of your evening, and we'll catch you later. Thanks.